Simon, hello and welcome to CamBro Conversations. Thank you for joining me.
Hey, Colin, my pleasure.
And we've managed to line up the different time zones. You've been over there in Singapore, and me with my my Glasgow accent managing to reach you.
Well, thank you for getting up early to meet with me.
Yeah, no problem at all. I'm definitely an early bird. But Simon, there's so much that we can talk about. And since we've been connected on LinkedIn, we've been firing ideas back and forth about where we can go with this conversation. And I was telling you, recent episodes I've done have been quite financial focused, and people are very interested in those. But equally, they are worried about what's potentially coming down the line. But before we get to that, I'd love to know where your own interest in money, finance, and in particular the markets first started.
Yeah, sure. Okay, so I guess my interest in the market started when I was at high school. This is in the 80s. Yeah, I'm pretty old. Just as a teenager, I used to love flipping back to the back of the newspaper, those printed things we used to have in the old days, and look at the stock price tables. And for some reason, it just the whole thing just fascinated me. And the 1987 stock market crash happened during my second last year at high school. And I had an economics teacher at the time who was, very passionate about what was going on in the market and what have you. And I was hooked. I was really hooked ever since I was a teenager, and dreamt of becoming a stockbroker. And I wanted the Ferrari, and I wanted the Daryl Hannah, and from the Wall Street movie, and didn't want the jail term, obviously. But no, the whole thing just kind of fascinated me. So I studied economics and finance at university, and my first job out of uni was as a futures broker. This was back in 1991, 92. It was a pretty deep recession at the time, and it was a real kind of trial by fire. But anyway, I progressed from there. I worked as a corporate credit analyst for a corporate bank for 3.5 years, and then eventually wound up working for Goldman. Started off as a private wealth advisor. And because of my futures background, I built a business around derivatives, focused on equity options. But I had a good derivatives background compared to most of my peer group. And one thing led to another. I ended up moving to Sydney and founding and running the markets desk for Goldman for between 2005 2010. I left Goldman in 2010 to join Citi in Singapore. And I, was very privileged to work with some of the wealthiest billionaires across Australia and the Asia Pacific, and a number of boutique investment funds as well. And then it was in 2017 I decided to leave the corporate world and do my own thing. And I'd sort of got to I guess a stage in my life and my career where I was in my mid-40s, and I thought, what am I really doing? What's my marginal contribution to society? And the answers I was coming up with weren't that impressive.
That
'Cause
contribution
essentially
sounds so interesting, isn't it, Simon? In terms of like what have I given back during this period?
Exactly. And when I analyzed what I'd done up to that point, it was mostly around keeping people who were already incredibly wealthy, even wealthier. And I thought, I've developed a skill set here. I've developed a skill set and a body of knowledge that could really be put to good use. And yeah, I decided to do something that would enable people who could really benefit from that skill set, rather than people who, frankly, didn't really need it. They'd already made it.
Yeah, it's fascinating, and I've loved your content since Darren Lee, previous guest on the podcast, introduced us, and I've been really diving into it, and I can see there's like a real driving force behind it, and you're also quite a mindful guy as well, Simon. Like I was reading that you're into your martial arts as well.
Yeah, very much so. I mean, martial arts have been a part of my life for most of my life. I started judo when I was 10, and then finished well, I wouldn't say I finished, but I guess the pinnacle of my martial arts career was becoming a qualified Jeet Kune Do instructor in 2017.
Interesting that overlaps with you leaving the corporate world as well. Like I do find that people that are like quite in tune with their bodies from that perspective are quite interested in managing their own things and doing their own doing life on their own terms as well.
Well, it also meant that I actually had the time to travel and go and actually do it. It would have been difficult to do that if I was in a corporate job.
Yeah, having to request the annual leave off to go and do that and leave your clients in the lurch.
Exactly.
It's interesting that you raised that you kind of were at the end of high school when we went through the 1987 stock market crash, you said, and then
Mhm.
you're trading futures in the early 1990s, where we're during the period of a recession. And recession is the word on everyone's lips at the moment, where people are worried about what's coming down the line. Interestingly, you said on LinkedIn again that the laptop class are proclaiming one of two things: either this isn't a recession, or is this the best recession ever? And
Mhm.
I've seen such strange dialogue around this particular period. Like, where's your head at in terms of where it compares to previous recessions that you've lived through and
Yeah.
worked through as well?
This the cycle we're in at the moment, it's a really screwy cycle, all right? Because we've had and I'm focusing on the US here because I trade the US stock market. The US has had 2 consecutive quarters of negative growth, all right? And that has been the generally accepted definition of recession since 1974. Now, there's this big debate raging now, both politically and online, as to, oh, well, maybe it isn't really a recession because we're at full employment. And that is what makes the current cycle so screwy. We've had 2 negative quarters, or two consecutive quarters of GDP declining, and yet the unemployment rate in the US is 3.5%, which is a generational low. But if you look at things like consumer sentiment, you look at the University of Michigan consumer sentiment, that's at an all-time low. All right. So even though people have got jobs, they're not feeling particularly positive about their circumstances. We've got personal debt, credit card debt is at a record high. The personal savings rate is at it's like a 13-year low. Um, so that there are all sorts of hints that yeah, people have got jobs and the economy is like it's not great, but it's not a disaster. But people certainly don't feel great about the situation, and sort of the macro statistics would lead us to conclude that their financial situation isn't fantastic either. They're carrying record debt loads in an environment where we're seeing the fastest increase in interest rates since 1981. You know, the velocity of the change has been historic.
I find it fascinating that some of the macro factors are telling us that things aren't as bad as people feel they are. And I wonder how much of that is a hangover from the level of fear that people have felt over the last couple of years with things like the pandemic, and just generally being a little bit spooked by media, but also losing trust in media and institutions as well during this period, probably more so than ever before. I certainly know that's where my head ended up at by the end of the period, if I'm honest. And I wonder whether people just generally are feeling a little bit lower in mood and outlook and prospects that they've got off the back of this period. And yes, there are some factors which indicate it's not as bad as it seems, but there's also some big factors, like you say, the saving rate at an all-time low, interest rates rising, which for me, as a little bit of a layman, Simon, seemed like an obvious thing that the interest rates have been too low for far too long.
Yeah, I mean, really, we've been in a fairly abnormal cycle since we came out of the 2008, 2009 global financial crisis. Interest rates have been held at artificially low levels for probably longer than they should have. And of course, the Fed really put the pedal to the metal post the COVID crisis in 2020 with not only zero interest rate policy, but a whole bunch of other measures and continued quantitative easing. And what we're finding now is that $9 trillion worth of balance sheet expansion doesn't happen in a vacuum. And we've sort of had, I guess, a perfect storm of we've had, yes, the massive quantitative easing, but we've also got trade friction, we've got deglobalization, and this has happened. I guess the cracks started to appear during the Trump trade war, and then the cracks became a chasm during COVID when everybody realized all of a sudden how utterly dependent our supply chains are to just a handful of countries. And when they shut down, or when transport shuts down, shipping shuts down,
Or
ports
when
shut down.
relationships are bad between them as well, because like you say,
Yeah.
a trade war, equally Russia and China, Russia for energy for the Europe, but China for almost everything that they ship across the world and
Mhm.
manufacture and produce. If you're super reliant on that, then you are a little bit at their mercy to some extent. I know that shipping costs, getting in my day job, Simon, we sell furniture into student accommodation.
Right.
Getting the same 40-foot container of furniture from China, it was 10x, 20x, 30x during the last 2 years. It just continued to rise and rise and rise. So it just got more and more expensive to get the same amount of items across to the UK. And then of course your customer bears the brunt of that, or our margin takes the hit.
Yeah, it's inflationary, right?
Yeah, exactly that. And it's very painful as well. You described it as a screwy cycle, and I think that's a really interesting term for people to get their heads around. It's because of those different factors as well, because as you say, if unemployment is relatively low, people would normally have higher levels of consumer sentiment, wouldn't they? Because they're in work, they're in steady employment, they have income to spend.
Mm-hmm.
But in sharp contrast to that, they're actually worried about what they've got to spend. We've got to talk about energy prices, food prices. I'm talking about furniture prices, but it's pretty much everywhere that we see, isn't it? I guess from your experience, why is this so different to previous recessions in that sense?
Well, because we're in an inflationary recession, and we haven't had an inflationary recession since the 70s. All right. The last few recessions we've had have all been deflationary in nature, particularly 2008, 2009. This is the first time we've seen an inflationary recession, like I said, since the 70s. And, all of the people who were, I guess, working the desks in financial markets back then have retired or moved on or are doing something different. So everybody's kind of going, huh? What do we do? It makes for a pretty uncertain scenario. In terms of the consumer sentiment, what's happened, we've had 16 months in a row now in the US where real wages have declined. This is because nominal wage increases haven't kept pace with inflation, and inflation has made everybody feel poorer. And it's a conversation point everywhere you go, whether it's the US, Australia, Asia. I'm sure it's the same in the UK as well. It's what people talk about in the supermarket line. It's what they talk about over dinner at a restaurant. When you get the bill, oh, wow, this has gone up. Cost of living has really gone up, and it's putting the screws on people.
Yeah, and at a time when you said there's loads of other factors too, like consumer credit's higher than ever before in terms of personal debt they're leveraged up to. I think you shared a stat that 58% of Americans live paycheck to paycheck. So there is no like fallback of what might happen after this. And I think 2008, you said it was obviously deflationary, but that's the only one in kind of my living memory. I was in late secondary, high school at the time, and the pain that was felt at that point, I noticed a lot of like friends' parents losing their jobs or downsizing in their houses and stuff like that as well. What can we potentially expect from this period? Will it be similar to 2008 in that sense?
I think it will. It probably. Look, I don't think we're going to see a property crash the way we did in 2008, but I think we will definitely see a steep rise in unemployment. The Fed have really told us as much. If it takes a recession to cure inflation, then that's the medicine we're going to have to bear. I think that the Bank of England, in fact, has been far more forthright in their assessment. The Bank of England said last week that they expect a recession that will last for 5 quarters, and they're expecting the inflation rate to peak at 13.3% in October. So that really is the worst of both worlds: soaring inflation and a protracted recession.
Yeah, that is incredible, isn't it? Like those two horrible words, but also horrible circumstances for what that means. And it is like it's that screwy atmosphere that we were
Yeah.
describing, that kind of phrase that's a little bit new to me, but I can particularly understand it. And equally, I guess from an unemployment perspective, I think it's always difficult, and I appreciate we can only work with the data and the figures that we're given, but we are seeing like a lot of firms with hiring freezes, albeit they're kind of like under the table hiring freezes. They're not really spoken about. We are
Mhm.
seeing more layoffs in the tech world, like particularly in like in the crypto space. I saw a number of layoffs in the NFT space, which I think you and I could both have told people that was potentially coming if they believed the hype at that point. But with these things creeping up, could we see like unemployment going like from 3.5 in the US to like 5.5 to 6 and stuff like that? And like, what impact will rising unemployment potentially have? Will that deal with inflation? We're saying in a recession might, but I don't know what the mechanism would be for that.
Well, the mechanism is demand destruction. So what the Fed is trying to do is destroy aggregate demand enough or to a point where there is no longer a supply-demand imbalance. Now, we obviously we had a CPI figure out yesterday It was the first cooler than expected CPI print in several months, came in at 8.5% versus last month's 9.1%. And so people are kind of rejoicing the idea that inflation has peaked, but it may well have peaked. I'm not completely convinced on that, but I'm open-minded to it. But it does look as though we're in a wage price spiral, meaning we saw a very strong jobs figure on Friday in the US. Non-farm payrolls came in at 550,000 or thereabouts. And we're not seeing any wage moderation. In fact, we're seeing wage acceleration. And what happens is in a situation where job openings are double the number of people available to fill them, is that for the first time in a long time, employers have got a little bit of bargaining power. Employers don't want to lose employees because it's really hard to fill those vacancies. And so with prices rising, employees can actually say to their employers, hey, look, cost of living's gone up, I need a pay rise. And employers will look at the employment statistics and say, well, we can afford to put prices up because everyone's got a job. So prices go up, wages go up, and then it creates a kind of vicious cycle. And it seems like we're already there.
It definitely feels like we're already there, and it's like you say, it's this juxtaposition of the environment and the prices are going up, but people can afford to pay it because they're still in work, but they almost feel like they can't afford to pay it. And I know that we had this bizarre advice in the UK where they said at year end, kind of financial year end in March into April time, the government were saying to employers like, oh, be like cautious when it comes to managing inflation through not giving out wage rises.
Mhm.
And that for me was like such a hard thing to take. Because, for example, if I feel like I've performed well, then I feel like, oh, well, why should the government be telling my employer that I should potentially not be receiving a salary increase to control the wider economic environment? That doesn't sit well with me as somebody that's big on like personal responsibility and like impacting things through my own actions rather than the wider environment and what's going on beyond that.
It seems like a fairly heavy kind of totalitarian response, really, doesn't it? It's
Doesn't
not a
surprise me
very
after the last couple
laissez-faire
of years,
response.
Simon.
Yeah, true.
Yeah, it's fascinating. You said before on LinkedIn that we've never had a soft landing after inflation's gone above 4.5%. We're obviously well beyond that now. Does this hard landing look like a prolonged recession, or what does that recession potentially look like?
Look, I think it largely depends on the Fed's response. So if we look at the experience of the 1970s, the Fed had a very stop-start approach to tightening monetary policy. Like inflation was evident, they started tightening, but every time the economy started to slow down, they'd back off and start easing again. Now, what we ended up with between sort of 1969 and 1981 was 4 recessions and kind of 3 peaks in inflation. And it was really a decade where the stock market went nowhere. It was a decade of a high level of both economic volatility and financial market volatility. And I think if the Fed adopt a similar approach here, where they get a bit scared if the economy starts to cool down a bit too quickly and they start easing again, the so-called dovish pivot that everybody's looking for, we could be in for another prolonged period of high economic volatility and multiple recessions. I think if the Fed stick to their guns and everything that they're saying so far, and look, I'm the first to acknowledge the Fed does have a credibility problem, but all of the Fed governors and presidents are saying that we've learned from our experience, and it's ridiculous to think we're going to be cutting rates in 2023. We're probably looking at a fairly deep but fairly quick recession. That would be my best guess. So I think that the recession that we've had is probably just a prelude, and there's a deeper, more meaningful one to come.
I think that's a fair analysis from everything that I've read, particularly of your content, but also from other creators online as well. And equally, for anyone that's opened their Hargreaves Lansdown or their Vanguard or their Swissborg or their Coinbase or anything like that, there's definitely been a relationship between bear markets and recessions previously. And
Mm-hmm.
you'd shared that since World War II, there's only been 2 bear markets that haven't had a recession, and that's defined by like a kind of 20% fall in the S&P 500. Can we expect this bear market to be so closely linked with the recession that we're about to go into?
Well, okay, let's go back to the screwy cycle bit. So there is a valid argument to be made that we're already in a recession using the accepted definition. And the S&P at its low on the 16th of July had pulled back about 23.5%. So there's your bear market, there's your recession. If you want to take a more sort of positive view of things, you could say, well, we're done and dusted. We've had the bear market, we've had the recession. Now it's onwards and upwards. And okay, I mean that's possible. I think it's unlikely, but I wouldn't be completely dismissive of it. The average bear market, sorry, the average drawdown though during a recession for the S&P since 1929 is 42%. So if we've had if minus 23% from the all-time high is as bad as it gets for the S&P, it would be a far more shallow bear market than average. And this is an environment of Fed tightening, not loosening. So I think it's unlikely that we've seen the ultimate low for the cycle.
That's extremely interesting for people that are investing but also trading, as we'll definitely come on to, because an extra 20% decline on top of the 23% already felt in July would be quite frightening for a lot of people to see those figures on their screen, I suspect.
It wouldn't be fun. It really wouldn't.
Yeah. I guess it depends on where you are in terms of your wealth accumulation journey as well. Like me at 29, turning 30 in October, I'm not as worried as maybe somebody who'd be closing in on their retirement.
Well, I mean, it's life changing in a bad way for somebody who's looking to cash in and retire in the near term, if that happens. I mean, it's already been rough, and what's made 2022 really tough for investors is the simultaneous fall in stocks and bonds. And again, this is what makes this cycle different from the last few or this recession, the fact that stocks and bonds have fallen together. In a deflationary recession, bonds rally because whatever yield you can get on bonds becomes quite valuable when you're faced with the prospect of deflation. But when inflation is running at 8-9%, a 2.5% yield on a bond isn't particularly attractive.
Yeah, I spoke to Nick Magilli recently on the podcast, and he's the author of Just Keep Buying, which is a very steady, solid dollar cost averaging approach to investing for the longer term. And he was saying that bond performance is in a place where he would pretty much advocate for an entire equities based portfolio unless you've got some sort of read on the bonds that he doesn't, which is extremely interesting because previously a lot of these guys that were in that kind of steady dollar cost averaging space would have not a large percentage of bonds, but a good portion of their portfolio would be bonds for them to kind of tick over and be steady with and know that was going to reliably move forward for them.
Yeah, look, I think bonds are it's tough to make a really bullish story for bonds in this environment. I think that unless you're trading them very tactically, there's probably not a value to be had for long-term investors here.
Yeah. The only other thing I want to ask about the recession, Simon, is we were talking about shape of recession there. So you were saying, for example, if we did bounce out in terms of if 23% was the lowest we saw the S&P, then that means we're kind of coming out of the bear market or we're not going any deeper into it. So that would be a V-shaped recovery in terms of the market, but also we would expect potentially the economy to go in line with that. But there's other shapes of recession that we could go into. And for example, the Bank of England forecasting, what was it, 5 quarters in a row of recession. That's more of an L shape. Is that the correct terminology?
Correct. Yeah. And there's a W as well, which I think is what the US is probably looking at.
Okay, so that would be recovery, bounce back down.
We have a dip and then a bounce and then another dip. I think that's probably the most likely scenario.
Yes, and I wonder how prepared psychologically our cohorts in the general population are for that level of economic volatility, because it seems that people are potentially more fragile or easily worried than ever before in this period. And I certainly know that my training background and my lifting and your martial arts probably help keep us a bit more level.
It's not something you can ever really psychologically prepare for, as much as you think you can when you're in the thick of it. And I remember 2008 like it was yesterday. It can be quite a stressful environment for sure.
Yeah, I can see that. Investors are obviously worried. I have always held myself up as somebody that invests. But Simon, you are a man that has great expertise in the trading world. How are traders feeling about the recession, the bear market, and everything it brings with it?
Well, the great thing about being a trader is you're really agnostic as to whether the market's rising or falling, because you can make money in both directions. All you really need to do is be accurate in terms of picking the direction and the timing. And if you've got the tools to be able to do that and put the odds in your favor, yeah, you can make a good living as a trader.
Yeah, so you can see yourself still being profitable during this period despite what's going on within the market.
Absolutely. I mean, I'm having a profitable month. I'm having a profitable year. Not as good as last year, but still, still nicely positive for the year so far.
Yeah, so it's almost in complete contrast to people that are investing for the longer term, albeit you're investing for the short term and then selling or flipping or whatever the terminology would be. And I'm sure we can get into that as we go, Simon.
Sure. Really and truly, a lot of people who think they're investors or see themselves as investors would actually meet my definition of a trader. In my opinion, in my definition, you're a trader if you buy an asset with an expectation that you'll be able to sell it at a higher price in the future. All right. If you're looking at quarterly earnings reports, if you're worried about what the Fed has to say on each FOMC meeting, if you're worried about CPI prints, if you're checking your portfolio every day or every week, I don't really think you're an investor. I think you're a trader. But you're probably doing yourself a disservice because you think you're an investor, which means you're probably not as well versed of the risks that are involved and how to manage them and mitigate them.
Yeah,
Um,
it's maybe a hard pill to swallow for people if you're saying that depending on what their time horizons are potentially or potentially how affected they are by news and what's coming in, they're more
well,
likely to see themselves as trading.
I think it's more a matter of purpose than time horizon. An investor is somebody who wants to own a stake in a business because they believe in the business, they understand the business, and they want to share in the profits and the cash flow of that business over the long term. Whereas a trader is somebody who buys an asset with the expectation that it's going to rise in price and they'll be able to sell it at a higher price in the future. And
Yes.
for me, that counts whether you're holding it for a day or a year or 10 or 5 or 10 years.
Yeah, no, I think it's a really interesting way to frame it. And it's certainly something that's like speaking to me in terms of like, I would see myself as somebody that's holding for 5, 10, 15 years. Like I don't expect me to sell my holding in the S&P 500 for a very, very long time. But of course, I bought it as an asset that I expect to be able to profit from in the future. It's just my time horizons are very different to somebody that's maybe checking in on a super regular basis.
Sure. And, if you're literally, I'm gonna just put it in the bottom drawer and just add to it religiously month after month in a very disciplined manner, and I really don't care about the price, then you probably do meet the definition of an investor. But if you're somebody who's gonna freak out if it's down 30% and wonder what you should do, and should you buy more or should you bail out and get all worried, this is where investors get in trouble because they haven't planned what they're going to do if things don't go according to plan. And I mean, there's this assumption that, you know, stonks only go up, right? That's sort of a bit of a Wall Street
Meme,
bet.
isn't it? Yeah.
But you've got to remember, I mean, if you look at the S&P 500 between 2000 and 2012, it went nowhere. There were zero gains, but there were two 50% drawdowns during that period. Now, if you've held and religiously kind of added during that first drawdown, which was sort of 2000 to 2002, you ride the wave back up to 2007, you're probably feeling, okay about things. You're sort of back to break even, and you're like, "Oh, thank God for that. I'm back at break even." And then when 2008 starts to unfold, I mean, that's really going to test your mettle and your belief. And a lot of people will bail out at the wrong time because it is just so painful. And then, you look at the S&P, there's a lot of cherry picking in data. I mean, yes, sort of 10% per annum is sort of the long-term return over the long-term annual return over the very long term. But, you could look at periods between 1969 and 1979 where stocks went nowhere. I mean, there was a 30-year period between 1952 and 1982 where the S&P 500 basically stood still. You look at the 30-year period between 1964 and 1994, sorry. It's another 30-year period where the S&P 500 basically just went sideways.
It's
Now,
multiple lost decades, isn't it?
well, people, they look at the S&P 500 as a way of building wealth. Now, let's pretend you're not building wealth for a moment. Let's pretend you're building a house, and let's just say you look at this building contractor. Everybody uses him. Everybody recommends him. He's widely touted, and you get him to build your house. And you pay him for 30 years, and at the end of 30 years, there's still no house. What are you going to do? You're going to run around ringing all your mates, telling everyone how great this contractor is at building wealth? No, you're going to call your lawyer.
Agreed.
So, there is this. I know you had Nick Majuli on your podcast. That is an approach. It's a very passive approach, and it's his approach and my approach are not mutually exclusive. In fact, they can be quite complementary to each other. I'm just saying to people, if you are looking to accelerate your wealth creation, or you're looking to generate a second income, if you want to retire in the next 5 or 10 years and you're just not sure how you're going to do it, you probably need something in your portfolio that's going to potentially accelerate your returns.
I completely agree there, because one of the things that Nick said was, say, for example, you're saving £500 a month, and that turns into £6,000 a year, and that's going into the market. If you get a 10% return on that, that's £600 on a £6,000 investment. That's nothing. You can't use that as a second income. You could probably make that money quicker with a couple of extra shifts on the weekend, or a small side hustle. You could do that, no problem at all. Like, we're talking like weekly, monthly, whereas that's an annual return. So you are singing from the same hymn sheet in terms of people understanding that you aren't radically shifting your financial position or your buying power or giving yourself a second job by investing into things that are getting potentially a 10% return, and that's certainly not guaranteed, particularly in today's market as we're discussing. So trading for people that are looking to generate wealth at a faster rate, or even to explore that opportunity, is a much more viable option. But there are so many scare stories, and again, we can only take the data that is presented to us, but there's always conversations like, like 90% of people that trade in the market lose. And I had a forex trader on the podcast probably about 2 years ago now, and he was kind of outlining how he's had success, but obviously caveating that with many people have great challenges with that as well. But obviously you're not trading for forex, Simon, so I'd love to get your expertise in terms of what you are trading and how it looks like and what's the setup.
So just to go back to your point about 90% of traders lose money, I think in forex that's not far off the mark. There was a report by FXCM, which is a major forex broker, and I think the statistic I recall was like 86%. Now the problem is trading is a job. It's a job like any other job. Now nobody thinks, tomorrow I'm going to become a brain surgeon and I'm going to rock up to the hospital with my scalpel. I'm going to start operating on people. Nobody thinks, right, tomorrow I'm going to be a lawyer and I'm going to rock up to the courthouse and start defending people. Nobody thinks, all right, tomorrow I'm going to become an engineer and I'm going to design airplanes and bridges and what have you. And of course, there are barriers to entry in these professions. You've got to get qualified. There's no barrier to entry in trading. Any mug can open up a brokerage account and just go for it. But that doesn't mean that trading isn't a skill that requires education and learning and experience. And it absolutely does. It's like any other job in that regard. It's just that the barriers to entry are so low that people are literally invited to open up an account and blow themselves up. And, there are brokerage providers out there that have tried to gamify the process of trading. And, to me, this is only going to end in tears.
Yeah, you see that kind of like 50,000 demo account or whatever. And actually, one of my most recent guests, Richard Dixon, was talking about that's how he first really looked at finance. He was like, wow, I played this game basically. And of course, it's like that because it magnifies your wins. If you were to have a good trade, then if you've been trading 50,000 kind of in the demo simulation account, then of course you can be like, oh wow, that turned into 60,000 or 70,000. That's a lot of money. So you then get your own credit card out and start getting involved. So yeah, you are right from that perspective, and it's very helpful. You bring the stats in terms of how successful people are within that. But Simon, you're trading in the stock market instead. And what's the setup for that? One of the key terms I want us to really understand is options. What does that mean?
So yeah, I specialize in trading options. So what is an option? Well, let me just give you a little hypothetical, and apologies in advance for the sexist example I'm going to give. But picture two men standing at a barbecue. All right. One man says, look, you've got 100 shares trading at $50. I'm going to let you sell those shares to me at $50 between now and the end of next month. And all you got to do is pay me $2 for that privilege. And the guy says, well, hang on a minute. What if these shares drop to $10? Well, that's okay. You can still sell them to me at $50. Well, that sounds pretty good. Well, what if the shares rally to $60? Well, you can still sell them at $60, but you're going to be $2 worse off because of that $2 that you paid me for this option to sell them to me at $50. And that is the example of a put option. And I raised the example of a put option here because we're in a bear market, and that's what a lot of people are asking me about at the moment. But a call option is same thing, sort of in reverse. Guy says, look, I've got these 100 shares here. They're trading at $50. I'm going to let you buy them from me at $50 at any time over the next month. The other guy says, well, hang on a minute. What if those shares rally to $100? Deal's a deal. You still get to buy them from me at $50. Oh, but what if they drop to $10? Well, then you lose the $2 you paid me for that privilege, for that option. But it's a lot less than the $40 you would have lost had you bought the shares at $50. So the beauty of options is you can, with a call option, it's like the analogy I use in my book, it's like renting a stock. I think options are like the Airbnb of the finance industry, because you go and rent that beach house in Malibu or that French chateau in the Loire Valley, and you get basically all of the benefits of ownership of that property for a finite period of time and a fraction of the cost. And that's a little bit like buying a call option on a stock. You essentially get a lot of the benefits of ownership of the stock. I mean, you don't get dividends, but you get to participate in any share price appreciation, but you only have to pay a fraction of the price.
I was going to say it's definitely a way that somebody with less capital can get access to stocks and potential benefits from those without the same amount of capital staked.
Yeah, you can start trading options with a fairly small amount of money. I mean, people always say, well, how much money do I need to get started? And I usually say, $5,000 is a good sort of ballpark figure, because it's enough to give you a bit of a diversification. You can have a few positions on. But I've got members who've started with as little as $600, and they've managed to kind of double their stake in a matter of a few weeks, and they've managed to get off to a really good start.
Yeah, I'm always interested in terms of what the potential returns are, because we've paid heed to the lofty 10% that people talk about on an annual basis. But how does that differ in the trading space if somebody's looking to build wealth at a faster rate?
Well, I always say to people, once you've learnt the systems that I teach, and you've got your first 100 trades under your belt, and that first 100 trades is sort of like your apprenticeship, if you like, after you've done the training. A good sort of returns target to aim for is 5% per month. Now, I don't like talking about returns publicly very much, because there is such a wide variation in expectations. Some people will say, 5% per month, that's impossible. It's impossible to beat the market. It's impossible to time the market. The market only does 10% a year. Can't be true. Other people will say, oh, well, if I can't turn my $1,000 into $1 million by the end of the year, I'm not interested. So there's a very broad range in expectations there. But I mean, if you can generate 5% a month and you compound that, so at the end of each month, you sort of reset your account and you start taking very slightly larger position sizes, you end up with a return of about 80% per annum.
Yeah, exactly.
And those sorts of returns can become, really life-changing.
And literally a second job, which is
Yeah, absolutely.
or a full-time job, as many people that have gone through your course will have found. So that's some of the mechanisms there, Simon. That's some of the returns that are possible. But one of the big areas that you talk about is risk management. And I guess before we get onto that, it's risk tolerance for me as well, because I think where people are, if you're somebody that's like getting a little bit worried or spooked by how the market is just now, I think trading might be something that gives them can be quite intimidating for them. But I suppose you're enabling people to take a bit more control of that and have some sort of risk management protocol in place to deal with the ups and downs more strongly than perhaps if you're just chucking money into your HL or chucking money into your Vanguard and hoping for the best over a period?
Well, the thing when you learn to trade, I mean, it doesn't eliminate uncertainty, but it gets you much closer to what the market is actually doing and is likely to do. I mean, there are no guarantees in trading. All we're ever dealing with is probabilities. All we're looking to do is stack the probabilities in our favor. But instead of sort of sitting there like a deer in the headlights, wondering what the market might do, you can say, well, if the market does this, then this is more likely, and if the market does this, this becomes the higher probability, and it can give you a framework, and you can sort of navigate the path that much more easily. You can say, well, if the market reaches this level, it's likely to hit the next milestone on the upside. The same is true as if it starts falling. And it's all about just stacking those probabilities in your favor. And over time, if you've got an edge, a probabilistic edge, and you manage your risk properly, you almost can't help but make money.
Yeah. How do people work on their risk management then, Simon?
So I think an important thing to start with trading is start with an amount of money that, if lost, it wouldn't affect your lifestyle. It wouldn't affect your ability to, pay rent or put food on the table. I don't say that because you're likely to lose all of that money. I say that because it means you can be unemotional about the money that you are trading with. And emotional control it's honestly the holy grail in trading. It's the final frontier. And this is where, having a sports discipline or a martial arts discipline can be really helpful, because when you're used to enduring physical pain, emotional pain, I think, is a little bit easier to bear as well.
Yeah, that's such a good point, and I suspected there'd be a big overlap in terms of your ability to tolerate that kind of thing, but also be like mindful and disciplined and relate that into the trading world. How can we manage our emotions? And I suppose, for starters, you've said using an amount of money that isn't going to be life changing should it not have its returns. But do you have any other protocols that can help you manage your emotion? Because people, in terms of money, it has the highest kind of excitatory power of all the things that we can think about, whether that's sex, religion, or politics, or sport. Money tends to get everyone going as much as anything else.
Yeah. What I say to people is, so position sizing is really important. If you're feeling surges of either euphoria or fear whenever you're in a position and you're seeing, red lights and green lights blinking in your brokerage account, you're probably trading too big. So just keep winding back your position size until you're on an emotional even keel. And what I say to people is, you shouldn't feel anything greater than sort of mild pleasure to mild disappointment. Anything outside of that, you're probably trading too big, and it's time to wind back your risk, wind back your position size. And then, I teach very specific techniques about hedging and diversification, and, when to take profits, when to cut losers. And it just empowers people to never be left guessing. Part of what I drum into people in my programs is how to write a trading plan. And a trading plan is nothing more than a contract between yourself and you. And it's an ironclad contract that you're always going to stick to and you're always going to follow. And a well-written trading plan means you are never left guessing. At any point in time, you know exactly what you should be doing with your positions and with your portfolio.
Yeah, if A happens, then I do B. If B happens, I do D. And it's almost like a flow chart from that perspective, perhaps.
Yeah, it's almost like a decision tree. But importantly, if you follow your trading plan, you'll never blow your account up. And one of my little rules for traders is, if you ever experience a 15% drawdown in your account, so if your peak NLV, net liquidation value, of your portfolio ever falls 15% or more, close all of your positions and just go flat for a minimum of 24 hours. Because the worst thing that can happen is, if you're on a bit of a losing streak, that's when people start to do stupid things. They make dumb mistakes. They trade rashly. They double down. They're less responsible about their stop losses. They're less adherent to their trading plan because they're just so desperate to try and make that money back. And the best thing you can do at that point, go flat, think about something else for at least 24 hours, get yourself back on an emotional even keel, and then reassess the market with a fresh pair of eyes and a much clearer perspective.
Sounds like excellent advice, doesn't it? And equally, to hark back to what you were saying about the euphoria, I think there is an image of people like celebrating behind their screen when a particular trade comes off that like makes them or like changes the game. But as somebody that's doing this for a living for many, many years, you're like, you should not be feeling like that on a regular basis at all, because I suppose if that's how you feel, imagine it if it went the other way, then you would be putting yourself in a much, like, imagine what the wall would look like. And that's not what you're going to see on Instagram or LinkedIn or whatever platform people use to share their successes.
Yes, it's going to feel very lonely if that's the situation you're in. But yeah, another rule I have is the no high five rules. If you feel like high fiving yourself about how good you are as a trader, it's time to just sell everything and go flat. Just the market is about to teach you a lesson. It works every time.
The market's about to teach you a lesson. I think that's profound, isn't it? And you'll have learned that from your time within it. Can you think of a time whenever you potentially felt too much euphoria, Simon?
Oh, look, I mean, it still happens. Every now and then, I will, if I've had a really good run, I'll give myself a little pat on the back and think, oh yeah, finally got the market sussed. And then I'll wake up at 2 a.m. and think, you idiot, close everything. And sure enough, a change in trend is nearly always imminent at that point.
Yeah,
It
it's
happens
actually a
less
question.
often now, but it can still sneak up on you. I mean, we're only human.
I was going to say it's a question I ask a lot of my guests because they come on as experts. What's something that you know and you always work on, but you still feel like you're constantly learning? And I think something as psychologically like evolutionary wired as like, yes, I want this like next high. That's always going to creep into particularly guys like ourselves that are ambitious and want to do well. Like these things are kind of within our programming that you kind of need to keep a tight control of.
Indeed. I'll share a saying with you that I really love because I think it's so apropos to trading. There's an old saying that you can't make a living in the theatre, but you can make a killing. Meaning, if you're an actor, it's very hard to make a living, but there's a very small few that make an absolute killing and become superstars. But there's thousands of or millions of starving actors out there. The thing about trading is that you can make a living and you can also make a killing. The problem is that most people get into trading with the idea of I'm going to make a killing, and it's almost as if they're trying to earn their retirement on every single trade, and they approach trading with I describe it as a lotto ticket-like mentality. And going back to a point I made earlier, trading is just a job. It's just another job. I mean, you go up to your job every day with the expectation that if you put in some solid effort and do the work, you'll get a paycheck in return. You're not going to work thinking, today I'm going to earn enough money to retire next week. This just doesn't work like that. And I think if you can take that same attitude into the job or the career of trading, you've got a very long future ahead of you.
That's such a great point, and if I can try and bring that to life a little bit, like I'm thinking, like I see commissions off the back of the deals that I do in terms of in the furniture space, and you can sometimes chase the big contract and do it at a terrible margin because revenue wise, it's fantastic. And I think if you were going in with that mindset to trading in terms of I just need to make sure that this one particular deal works or one particular trade works, then you expose yourself to far greater risk and downside than if you just see it as a longer term picture and see it as a job that you're going to accumulate over time. Like for example, if I do a deal of a particular size, my bonus will be like more than salary. So
Mm.
that is something that people could chase if they did in the trading space. But that one particular trade or deal might not be the right thing for you to do because you've got overexcited by a particular figure that you've seen in terms of like this is going to retire me or this is going to financially change my situation massively. Because when you do start to earn those figures, of course it radically changes your buying power and the things that you can do.
Yeah, that's a very good analogy. Whenever you're feeling any sort of surge in emotion, it's a warning sign, whether the emotion is positive or negative.
We spoke about expectations for earning power, but also and like returns. But what about in terms of expectations of the market? Because quite often we see the stock market move in line with the news, but equally we sometimes see the stock market fall when the news is good, or it can even rally when the news is bad. What are some of the other things that you and your traders focus on when it comes to price action and where it's going?
So in essence, it's about identification of trends. So what we're looking for is trends and momentum and cycles within those trends. So, when a stock is in an uptrend, it will have little movements against that uptrend, called dips or pullbacks, and we're looking to buy those. When a stock is in a downtrend, it will have rallies against that trend, bear market rallies or counter trend rallies. We're looking to short those or buy put options when they happen. There are also periods of time where a stock just goes quiet. And what usually happens is periods of high volatility precede periods of low volatility and vice versa. So if a stock goes quiet, often it's storing up energy for the next big move. So we try and identify them as well. And it's just all about being very in tune with and responding to what price is doing. And to as great as an extent as possible, tuning out the news, tuning out the noise, tuning out the headlines.
Yeah. When it comes to market internals, what are some of those things that you would maybe like share with us that we should be thinking about?
If you're looking at things like market internals, I mean, the VIX, I think, is a relevant one. When the VIX is relatively high, that's when everybody's running scared. That's when the news headlines are dreadful. But when you see the VIX really surge, that's a really bad time to be bailing out or shorting. That's the time to kind of hold on, or if you know what you're doing, potentially even do some buying. Conversely, when the VIX reaches a comparatively low level, that's when markets feel confident and sort of relatively happy. It's usually not the time to be going maximum long, even though your emotions might be telling you to do that. The put call ratio is another one that you can look at. That just gives an idea of how long or short the market is. There'd be certainly a couple of the market internals that I look at fairly regularly.
Yeah. What impact do you think the kind of whole Reddit, GameStop, AMC, those threads, what impact do you think that had on the reputation of trading?
Yeah, that's a really interesting question, because it was such a dominant force throughout the latter part of 2020, particularly in those meme stocks. And I mean, it caused the failure of a fairly prominent hedge fund. Good luck to them. Look, I think this whole idea of social investing, it's got legs. I think it's got a future. It's still in its infancy, a little bit like crypto, I guess. It's still relatively very, very young, and we're yet to really see how it's going to evolve and what it's going to look like. But I certainly think millennials and Gen Z, they're not really that interested in reading Wall Street research reports. They're very cynical and justifiably so, I think. And so they're looking to get their information from other sources. It's not always easy to verify the quality of the information that's being shared, but I think it's an interesting space to watch.
Yeah, I think social investing is definitely interesting, and it's got that tribe element to it, which a lot of us are seeking because we've lost a lot of community, whether that's being in a more secular society nowadays with less religion, or maybe people are working from home more, so they're not in an office environment, and not having people around you as much. You kind of seek community in other aspects, and some people seek it through like fitness. I've spoken to CrossFit athletes that absolutely swear by the kind of community and the family feel that they've got from their gym, and I'm sure you've got a deep connection with the people that you practice martial arts with and teach and coach and spar with. But some people were kind of finding that in an online community where they were like, we're all in this together and we're all working towards this one goal where we're going to take money from the man who's locked us inside during this lockdown and
Yeah.
made us poor. And I think when I was speaking to Dr. Daniel Crosby in the podcast, he was saying that one of the things is like, there was a lot of people who were like, like my parents lost their house in 2008 because of the system and the man. So I'm now using this opportunity to take back what they kind of took from me.
Mm-hmm. Yeah, it's a really good point, actually. And I think you're right. That sort of sense of community or tribalism is probably appealing to a lot of people. I don't know that it's necessarily a path to success in an avenue like trading, but it could certainly fulfill, I guess, other emotional needs.
I think I would be a lot calmer having read your book, consumed your content, gone through courses to get involved with trading than if I had jumped on a Reddit thread and followed off somebody who's kind of flexing. Because those whole threads, the reason they were kind of initially famous before kind of late 2020, was because people were sharing their fails. Like they were sharing like when they'd completely like leveled out their account, and they'd like YOLO betted on something and it had gone wrong. So there's people within that audience and within that maybe have like a high ranking in terms of number of posts and stuff like that actually have a background in trading of regularly blowing it and not being successful, and they're maybe seen as like high level moderators within those chats too.
Right. I guess the one issue I have with a lot of it is nearly all of the posters are anonymous, and there's I think it's very difficult to verify whether what they're saying actually happened, or how true it really is. There's probably a fair bit of poetic license going on there as well, I would think.
Yeah, throwing up the odd screenshot that they've maybe doctored on Photoshop to make it
Yeah.
look like they've traded an extra zero or two.
Yeah, that would be my concern.
Yeah, absolutely. So, Simon, we've covered a lot of different topics: recession, bear markets, trading. What are your expectations for the next year or so?
I think just lots of volatility. I think the market is going to be, it's going to be saying hooray 1 minute and oh dear the next. I think we're going to go through cycles of this. It'll largely be dependent on the economic data that comes through. But as interest rates push higher, I think we can expect unemployment to start becoming more of an issue. My personal view is that the Fed will continue down this tightening path either until inflation is, very low single digits, or until unemployment displaces inflation as the major concern of the man and woman in the street.
Wow, I mean, that's a consideration, isn't it? When unemployment overtakes inflation as the concern, then we might have inflation more under control, but only because something else has overtaken it.
Yeah, I mean, this is the thing, right? The cure for inflation is likely to, well, very likely to be a recession. Inflation is, we're seeing it's politically very unpopular. We're seeing all sorts of polls in the US, disapproval ratings for Biden and handling of the economic situation, and is the country on the right track and what have you. And inflation is proving to be very unpopular. Recessions are unpopular too. And as clinical and as callous as this sounds, recessions hurt a comparatively smaller number of people at the end of the day. It affects a smaller number of votes. So yeah,
Oh, so
it's
if they're
devastating.
if you were to calculate the potential political loss or loss of their majority in different states, it might actually be politically more palatable to go through a fairly tough recession than it is to have this continued like rampant inflation that we're seeing. Because again, I would sometimes disagree with the figures that we see, even like 13% in the UK. There's very few things that I'm buying that are under 13% increase in cost in the last little while.
Right. So yeah, inflation, it makes everyone poorer, whereas a recession makes a small number of people drastically worse off. So that's kind of the political football game that's being played there at the moment, I think. Um, Now, look, could the Fed engineer a soft landing? Look, it's not impossible. All right, there is a greater than 0% chance, but based on track record of hiking cycles and where inflation is, you'd say that the odds are not in their favor.
Yeah, exactly that. And I guess to share like an interesting thing that I was talking about with my dad of all people, he was saying to me that saving used to be really like heavily encouraged. So like when I was like young, they put money into a savings account for me when I was at primary school and stuff like that. And the return from the bank was actually really high. Whereas in
Mhm.
my entire adult life, I've seen no return from putting any money into a savings account because interest rates have been so low. So I wonder if we'll ever get back to an environment where saving is actively encouraged through the institutions in the way that it previously was.
Well, if we could get there, um, but I think interest rates will need to be substantially higher than where they are today. Now, the problem is though that the world we're in is one that requires low borrowing costs and constant growth. All right, you think about money, right? There's a lot of talk about money printing. Well, if you think about the money today, money and credit at the sort of in the macroeconomic level are the same thing. If I go into a 7-Eleven store and buy a can of Coke, it makes zero difference whether I spend dollars out of my wallet, whether I use my Visa card. So really money and credit, basically the same thing. 95% of what we think of as money has been created by commercial banks when they issue loans. And so what happens, Colin, when you go and borrow $1 million from the bank, you've now got cash sitting in your bank account of $1 million, and then you've got a liability, a loan that needs to be repaid back to the bank. And conversely, the bank has now got this asset, this loan of $1 million as well. Now, what's changed is, whilst the bank has created, literally out of thin air, that $1 million, which is now in your bank account, it doesn't create the interest that needs to be repaid on that loan. You've got to come up with that. All right. And so to come up with that interest, there's got to be some sort of growth somehow. We're talking about whether it's productivity, whether you work and earn the money to pay the loan off, or whether it comes off in form of investment returns. But some form of growth is required to service the interest. And we're at a point now where the total debt to GDP in the US is at about 355%, and it was at about I think 160% this time 40 years ago. So it's doubled. Yeah. And in that environment, a highly leveraged environment is far more fragile. And like I said, it requires constant growth to service the interest, and very low borrowing costs, again, to service the interest.
And it's a massive structural problem then, isn't it? Rather than just the fact that they've printed a lot of money to deal with the 2008 crash.
Yeah, absolutely.
Wow, so much to think about, Simon. I've absolutely loved this conversation, and probably opened me up to making sure that I have you back on in the near future as the economic situation continues to evolve. But for those that want to continue the conversation with you direct, where should they head towards?
So they can follow me on Twitter. I'm at Simon_Ree, R-E-E. They can follow me on LinkedIn, Simon Ree. And I've actually prepared some resources for your listeners, for your audience. If they head over to taooftrading.com/CamBro, so that's taooftrading.com/CamBro, they can get the first chapter of my book for free, and they can access some resources at a pretty hefty discount as well.
Excellent, Simon. Thank you very much for doing that. That will all be linked in the show notes below. I'm sure you've all enjoyed this conversation, and I'll be back to speak to you all again very, very soon.